Welcome to Financial Management. During this 7-week course, you will take on the role of a CFO assistant for a publicly traded company. You will work with the same company throughout the course, using financial information to support practical business decisions. We begin by examining the role of financial management in creating value. You will learn how financial statements tell the story of a business, why accounting income differs from cash flow, and how to calculate free cash flow. You will also use financial ratios and DuPont analysis to evaluate your company's performance, strengths, risks, and limitations. In Week 2, we explore one of the most important principles in finance. Money available today is worth more than the same amount received in the future. You will apply future value and present value concepts to individual cash flows, annuities, perpetuities, and loan payments. These tools provide the foundation for valuing bonds, stocks, projects, and entire companies. We will then connect valuation to risk. You will examine expected return, portfolio risk, and the benefits and limitations of diversification. The goal is not simply to calculate a present value or security price. As a CFO assistant, you must also explain what the result means, which assumptions drive the value, and how risk should influence a financial decision. In Week 3, we ask two central questions. What return do investors require, and what discount rate should a company use when evaluating an investment? You will use beta and the capital asset pricing model to estimate the cost of equity. You will then combine the costs of debt and equity to calculate the company's weighted average cost of capital. Next, you will evaluate investment opportunities using net present value, internal rate of return, modified internal rate of return, payback, discounted payback, and the profitability index. Your task will be to move beyond reporting several calculations. You must determine which decision rule should carry the greatest weight and give the CFO a clear go or no-go recommendation. A project can appear profitable until its cash flows are identified incorrectly. In Week 4, we examine how companies build a complete capital budgeting analysis. You will distinguish relevant cash flows from sunk costs and allocated expenses. You will incorporate taxes, depreciation, working capital investment, opportunity costs, and terminal value into the project evaluation. We will also examine project selection under capital constraints and compare alternatives with different economic lives. Because forecasts are never certain, you will evaluate how changes in important assumptions affect the project's value. Scenario analysis and managerial flexibility will help you consider whether the company should proceed immediately, modify the project, delay it, expand it, or abandon it. In Week 5, our focus shifts from deciding where to invest to deciding how the company should finance its operations and manage its short-term resources. You will examine the effects of debt, equity, and financial leverage on shareholder return, risk, taxes, financial distress, and financial flexibility. You will also consider how capital structure theories help explain actual corporate financing choices. Next, you will analyze liquidity and the cash conversion cycle. This connects receivables, inventory, and accounts payable to the company's cash needs. Finally, you will evaluate payout policy, including dividends, share repurchases, debt reduction, and reinvestment. Your recommendation must balance shareholder returns with liquidity, resilience, and future growth opportunities. In Week 6, you will look forward rather than backward. You will prepare simplified financial forecasts and examine how sales growth affects operating needs, assets, financing requirements, and future cash flows. You will also evaluate internal growth, sustainable growth, and the need for external financing. We will then use free cash flow to estimate corporate value through discounted cash flow analysis. You will distinguish enterprise value from equity value, calculate terminal value, and estimate value per share. Remember that valuation is not simply the result of a formula. It depends on assumptions about growth, profitability, risk, and long-term performance. Your responsibility is to identify the assumptions that matter most and explain how uncertainty affects your conclusion. In our final week, we bring the course concepts together through strategic, International and responsible financial decision making. You will examine mergers and acquisitions, including acquisition premiums, expected synergies, and the possibility that a transaction may create or destroy value. You will also consider foreign exchange exposure and the challenges of evaluating investments across countries and currencies. Financial decisions do not occur in isolation. Governance structures, executive incentives, agency conflicts, ethics, stakeholder consequences, and environmental, social, and governance considerations can all affect long-term value. By the end of this course, you should be better prepared to analyze financial information, evaluate alternatives, and communicate with the clarity and confidence expected of a financial leader. Throughout the course, generative AI will support your research, calculations, interpretation, and communication. However, AI does not replace your judgment. You are responsible for verifying its output and defending your recommendations. By the end of this course, you should be better prepared to analyze financial information, evaluate alternatives, and communicate with the clarity and confidence expected of a financial leader. I hope you will enjoy the course, find it practical and relevant, and leave with a stronger understanding of how financial decisions shape the future of a business. I look forward to working with you this semester. Welcome to Financial Management.